Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Alibaba's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Alibaba is a Chinese e-commerce, retail, internet, and technology company. It has three main websites: Taobao.com, Tmall.com, and Alibaba.com. Taobao.com offers customer-to-customer services where individuals or businesses can sell items on the website. It is similar to eBay, where it acts as an intermediary between buyers and sellers. It does not warehouse products and deliver them like Amazon does. Taobao consistently ranks in the top 10 most visited websites in the world, and it usually ranks higher than Amazon. Tmall.com offers business-to-customer services. Only the brand owner or authorized dealer can operate a Tmall store. For example, Tencent may use Tmall to sell its products. And their third big website is Alibaba.com, which is one of the world's largest business-to-business marketplaces. Any company can sell on Alibaba.com, not just Chinese companies. Most transactions on its website are processed using Alipay, which is similar to PayPal. Just to show you how huge Alipay is, in 2019 it processed $17 trillion in transactions, where PayPal only processed $172 billion. Just this week, Warburg Pincus cut its valuation on Ant Group by 15% to below $200 billion. Other investment banks also cut their valuation on Ant Group. Ant Group is an affiliate of Alibaba and owns Alipay. In October of last year, Ant Group was set to raise $34.5 billion in the world's largest IPO ever. On the eve of the IPO, the Chinese government stopped the process from moving forward. Subsequently, Ant Group was transformed into a financial holding company overseen by China's state-controlled central bank. Alibaba is one of the largest, most valuable, and most identifiable brands in the world. It has 1.2 billion active users on its different platforms. The company is headquartered in Hangzhou, China, and was founded in 1999. It trades on the New York Stock Exchange, Mexican Bolsa, Deutsche Börse, London Stock Exchange, Xetra, Vienna, Swiss, Buenos Aires, Hong Kong, and Bulgaria Stock Exchange. Let's get started with the model. This is a large cap company, 361 billion market cap. They're trading at $133 a share, and they have 2.7 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they have a ton of free cash flow, 16 billion up to 25 billion. It peaked in 2020 at 30 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's also huge each year, 12.8 billion up to 18.6 billion. Revenue is the sales for the company, and that just goes up at a really nice clip each year, from 60 billion way up to 130 billion. This is the company's income statement from Yahoo Finance. In a little bit, we're going to look at their income statement from their latest quarterly report. All of their financials are in Chinese ones. I converted the numbers to US dollars on my Excel spreadsheet since we're looking at the ticker that trades in the US. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that grows a lot each year, doubling from 2019 to the trailing 12 months. Below that is their operating expenses, and then their operating income, which did peak in 2020 at 93 billion. It has come down in the trailing 12 months, so it looks like their expenses are getting higher. They don't have that much debt relative to the size of the company. They paid 4.8 billion interest on their debt. They received 43 billion of interest income from their investments. And the bottom line of the income statement is their net income, which peaked in 2021 at 143 billion, but it's still over 100 billion in the trailing 12 months. So it looks like a really solid income statement. Here's their third quarter income statement from their quarterly report. Their revenue was 200 billion wons. Here's a breakdown of their revenue. Their highest is commerce, 171 billion. And here's a breakdown of commerce from their quarterly report. This comes from their online marketplaces, SunArt, Fresh Hippo, AliExpress, Alibaba.com. A majority of this is the fees they charge throughout their websites to use their services. 20 billion of revenue from cloud computing. Within cloud computing is elastic computing. This is the ability to meet changing demands by the customer to expand or decrease memory, processing, or storage. Security features are part of cloud computing, management, application services, Internet of Things. As you're probably aware, Amazon Web Services is the largest cloud computing company in the world. They have a 32% share. Then Microsoft is second at 20%, Google Cloud is third, and Alibaba is fourth. 8 billion in digital media and entertainment. This is from Alibaba Pictures and Youku. Youku is similar to YouTube, where it's a video hosting service. And they give a breakdown of their revenue, 130 billion in cost of revenue. A lot of this is payroll costs, depreciation, amortization, 15 billion of product development costs, 29 billion of marketing, G&A is 9 billion, amortization of 3 billion. So they have 15 billion of income from operations. The reason net income is so low in the third quarter, they had an investment loss of 11 billion. And according to their quarterly report, the losses are mainly due to their investments in public companies. So as you know, Chinese companies have really struggled lately. Their stock prices have gone down a lot, and some of them have taken losses. In order to accurately reflect those investments, they have to pass through a loss onto their income statement. In most quarters, they have a big gain in investment income. I think in the third quarter of 2020, it was a 10 billion gain, and this quarter it's 11 billion loss. So they have a really small profit in the third quarter, only 3 billion. I like to see how much cash flow they generate from their operational business, and we can find that on their statement of cash flows. They generated 36 billion wons of cash flow in the third quarter from their operational business, which is a lot higher than the profit they posted. So that is a lot better, but it's a lot lower than what they usually post per quarter. Most quarters, they're between 40 and 60 billion of cash flow. So the third quarter was bad for this company. Unfortunately, in their quarterly report, they don't list all the detail in their statement of cash flows, only their annual report. This is their statement of cash flows from Yahoo Finance. In a little bit, we're going to look at the statement of cash flows from their annual report to get more detail. The top line is operating cash flow. That's how much cash the company generates from its operational business. So they do generate about 200 billion of cash flow annually. That's a ton of cash flow. That's about 50 billion per quarter in the trailing 12 months, close to 60 billion in 2021. That's why I was saying earlier the third quarter was a lot weaker than prior quarters. They do invest a lot in CapEx, but it's a small amount relative to their cash flow. So they have a ton of free cash flow remaining. Free cash flow is operating cash flow minus CapEx. They don't pay a dividend. It looks like they only bought back stock in 2019 and 2021, and they didn't buy back much in 2021. They bought back 11 billion in 2019. When a company buys back stock, it decreases the shares outstanding, making your shares more valuable. And it looks like they added a lot of debt in 2021. They did pay down debt in 2020 and 2019. And they issued a ton of stock in 2020, 91 billion. They may have been taking advantage of the really high stock price. So that's why they issued equity that year. When the stock price is really high, you want to see the company issue stock and not debt. When the stock price is really low, it's better for the company to issue debt than stock. Of course, the best thing is if they could fund their growth on the cash flows from their operating business. But if there's a big acquisition, not a lot of companies, except for maybe Berkshire Hathaway and Microsoft, are sitting on $100 billion of cash. This is the company's cash flow from operations section in their statement of cash flows, and this is for 2021. And the way you calculate CFO, you start with net income, then you have to add or subtract the non-cash items on the income statement, then you have to adjust for changes in working capital. So they had 143 billion of profit. They passed through a gain of 57 billion onto their income statement in 2021, and that gain was from their investments in other companies. Let's just say, for example, they own 25% of Bilibili. Bilibili is a YouTube of China. And say, for example, Bilibili reported a net profit of 100 billion on their 2021 income statement. Since this company owns 25% of Bilibili, they would pass through a 25 million gain onto their income statement. But net income is not a cash item. So we have to subtract that out in a statement of cash flow. So that's a minus 57 billion. But if Billy pays a dividend, say they paid 1 billion in dividends to all their shareholders in 2021, since they own 25%, they would have to report that 250 million dividend onto their income statement. And they pass through an 8.8 billion gain on a revaluation on some of its investments. It's possible the company Alibaba is invested in had to revise their financials. So that's why they're showing this revaluation gain. They own a lot of fixed assets, so they pass through a 26 billion loss onto their income statement. So we have to add that back on the statement of cash flows. And they pass through a 21 billion loss on amortization. They paid $50 billion in stock to their employees. That's a non-cash item, so we have to add it back here. And it looks like they purchased 77 billion on credit. So when you buy something on credit, it's kind of like taking a loan. So it's a cash inflow at the time you buy the product. But when you actually pay for the product, it'll be a cash outflow. So even though they reported 143 billion gain, they actually generated 232 billion of cash flow. This is their cash flow from investing section, and they had a cash outflow of 244 billion. Usually property, plant, and equipment will be on top. At least in the United States, it's on top. But they put it in the middle here. They spent 43 billion of CapEx. 41 billion was for land use rights, also property and equipment, and 1.7 for licensed content, because they have to buy a lot of content from other people to put onto its platform. They don't have to buy content for Alibaba.com, but this is probably related to their video streaming subsidiary. It looks like they spent $19 billion in business acquisitions, and they spent $19 billion in acquisitions from equity method. This is probably related to how much money they spent in acquiring stock for another company. And they had a cash inflow of $30 billion from financing activities. This $11 billion is the dividends they received from some of the companies they're invested in. And they added 32 billion of debt, they paid 7 billion of debt, and they borrowed 6.4 billion from the bank. It's a lot of things going on. It could really make your head spin trying to make sense of it all, but I would just focus on the high level. They have nearly 1 trillion of equity on their balance sheet. They raised 400 billion from selling their business, and they profited 570 billion from running their business. Let's look at the capital structure. 154 billion of equity, 24 billion of debt. They're 86% equity, 14% debt. And their net debt is negative 49 billion, so they could pay off all the debt with the cash on their balance sheet and still have 49 billion of cash left over. I gave them a lot higher whack than Finbox and Simply Wall Street. And I think the stock is much more riskier these days because of all the issues they're having with the Chinese government. I think there's a lot less appreciation with the stock price. I think it's pretty capped at this point because, as you notice, the stock price keeps going down. Although I do feel it should be a lot higher, but it's hard to know when it's going to come back up. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for that 600 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $510 billion. We divide that by 2.7 billion shares. And we get a calculated stock price of 188. They're trading at 133, so they're trading at a 29% discount. It's a buy according to the model. The average analyst projects their revenue to grow 15%. So to calculate their future revenue, I grew at 15% for the next 4 years. And to calculate their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers, and I divided by these 4 revenue numbers. And that comes out to 24%. So I multiplied their future revenue estimates by 24%. And even with the higher whack, I'm still coming out with a stock price a lot higher than they're trading at. Simply Wall Street's valuation is 178, so they're also saying the stock is undervalued. 23 analysts priced this stock, and the average price target was 215. The low was 170, the high was 275. This is where the stock has been trading the last 5 years. The stock peaked at the end of 2020. It was close to 350 a share. Then all this negative news coming from China. The politicians were trying to block companies from IPOing in the US. And then the Evergrande fiasco. That's China's second largest real estate developer. And that company was so over leveraged, they thought it may file bankruptcy. It seems like every month they're able to get funding at the last minute to avoid bankruptcy. All Chinese stocks have really struggled the past several months. And this bottom chart is Baidu. And you can see Baidu is even more severe. It seems like it went up a lot more percentage-wise than Alibaba, and it dropped a lot more percentage-wise. So Alibaba is not alone. Lots of Chinese companies are going through this problem. Although I think the stock price would have come up quicker, but there is concern that Alibaba has a lot of competition, and that's why their financials aren't as strong the past couple quarters. They still have a ton of free cash flow, but it's just a little worse than analysts expected. They have a pretty low beta, 0.86, so the stock moves less than the market. It's gone down 51% in the past 52 weeks, while the S&P is up 30%. The 52-week low was 131, the high was 279. And of course, the stock is trading below its 50-day and 200-day moving average. And there's a ton of activity on this stock. Each day, over 20 million shares are traded. Of the 2.7 billion shares outstanding, 1.9 billion are on float. 24% are held by institutions, and under 2% of the shares are shorted. A really bullish sign is seeing companies add employees. In the past few years, they've added a ton of employees. They have over 250,000 people working at that company. If you invested $10,000 into this company when it started trading in the United States, you would have tripled your money if you sold last year. But if you're still holding, you'd be at $14,500, which is a little over 5% annually. The biggest shareholder is SoftBank. I did a video of them last week. The second biggest is Vanguard, the CEO Jack Ma, BlackRock, and Goldman. Let's look at their financial ratios. Their PE is 19.4, which is a really good PE for a company that's growing at their pace. When you see a PE this low, you would expect the company not to have that much growth potential. And since their market cap has been cut in half, their price multiples look really attractive. Their price to sales is 2.8, which is at the market median, which is a great price to sales for this company. And their price to book is also really good at 2.3. Price to book is stock price over book value per share. And the way you calculate book value per share, it's equity over shares outstanding. Equity is on the balance sheet. It's assets minus liabilities. And they have 154 billion of equity, 96 billion of tangible equity, since they have a good amount of intangibles on their balance sheet. This 360 billion is in Chinese ones. The 154 billion is in US dollars. Their return on invested capital is pretty good. It's over 10%. They can cover their interest payments 18 times. They have a good ROE, much better than the market median and average at 12%. They have a high current ratio and quick ratio of 1.6. They have so much cash and short-term investments on their balance sheet. If you want to know what these numbers are in US dollars, you can just divide by 7. So roughly 40 billion in cash and about 23 billion in short-term investments. So the company is really well capitalized. They generate 25 billion of free cash flow in the trailing 12 months, and they have 40 billion of working capital. Working capital is current assets minus current liabilities. They have over $60 billion of funding. The best way to look at ratios to compare them to companies in the same industry, I've done videos of 15 companies in the same industry as Baba, and look how amazing their ratios are. Their PE, price to sales, and price to book are so much better than average. They have a good current ratio. Their ROE is higher than average. They're much lower in debt than the average company. And they're still a huge company, 360 billion market cap. Although their market cap should be over 1 trillion for the amount of profits and cash flow they generate. So to summarize, I have them trading at a 29% discount. And this stock is trading at such a bargain. Even with that really high whack, the stock price is still discounted. But I think this stock should be trading over 1 trillion market cap. More people go to their websites and apps than pretty much any other company in the world. The only company that maybe has more coverage is Google. And I know there's a lot of big investments like Charlie Munger who are really bullish on this company. It's just a matter of time until they blow up. The hard part is sitting and waiting. And it's even harder seeing the stock price go down. But patience is a virtue, and the people who are patient are going to get rewarded really handsomely. I rank their free cash flows 8 out of 10, their revenue 10 out of 10, and their ratios 9 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.